What does Brexit mean for bond markets, both here in the UK and worldwide? To help us answer that question, we're joined by Bob Michele, who for JPMorgan Asset Management oversees $430 billion worth of bonds. Bob, thanks for joining us.
I'm glad to be here.
So Bob, I think the question for us is Brexit something new for bond markets, or is it just accelerating the trends that you were already having to deal with as an investor?
I think it's a little of each, frankly. I think it is something new. When we look at the markets pre-Brexit and post-Brexit, there is a difference about the preference of bonds that people are looking for. There's a bit more flight to quality and a bit more fleeing and looking for a safe haven and becoming more risk off. I think what's also new about it, frankly, is the uncertainty it's created in the markets. And the capital markets just simply don't like that. They like certainty. They like to know what policymakers in particular are doing. And it's two of the most critical months for the markets. It's July and August when liquidity is thin. I think what is the same for the bond market, frankly, is that there had been demand for bonds over the last couple of years. The amount of quantitative ease coming from the central banks was flowing into bond markets and keeping yields low. That's not going to change.
And I think you've got a chart here which gives us some of the context for sort of what you're looking at as a bond investor.
Yeah, and how the story has changed. When you look at this chart, and it's a chart looking at the percentage of the global bond markets with yields below the 10-year Treasury, and it's something like 84, 85% of the market had a very low yield. Much of the discussion was what the Fed was going to do. And it was all so clear. They weren't going to raise rates in June because they wanted the Brexit vote to clear. There was enough growth and inflation in the US for them to do it, so they would come into the July meeting and raise rates another 25 basis points. I think you can take that off the table, and I think it makes the US bond market particularly attractive.
So what do you think is going to happen from here? What do you see sort of for the UK and sort of for US investors? How are they going to react to this?
Well, I think there are going to be a couple of things that are going to happen. I think certainly there's going to be an acceleration of money into bonds. But I think that money, which had been going into things with a bit more risk, so high yield, emerging markets, things with structure, credit, and liquidity risk, that will tail off, and there will be more of a flight to quality trend. I like to say the things that the central banks are buying and investing in, those will get the best bid. So governments, high quality corporates, and then 1 degree of separation from that. So even though the Fed isn't buying US corporates, you'll get some spillover from the ECB and the Bank of England.
So we should see that buying push down yields ever closer to zero, certainly in Europe. And where do you think they go in the US?
Well, I think they're going to go substantially lower. I think right now we're looking at a 10-year Treasury yield at about 1.5%. I think it's going to close in at 1%. I think 10-year gilt yields are going to go lower as well. I think that they could go down to 50 basis points. If I were the MPC, I would take that one question in the market about what their policy is going to look like and take it off the table. I would cut rates to zero today.
And we've got one final chart here. What is this showing us in terms of the sort of, this is the US financial conditions?
Yeah, and this is a measure of whether financial conditions are tightening or easing. It's something that Yellen looks at. She looks at two pools of data. One is the typical fundamental data, so growth and inflationary pressures. The other is financial data. And the key inputs to financial conditions are credit spreads, the equity market volatility, and the strength of the dollar. Financial conditions are tightening as this line is rising. And this is telling us that financial conditions were quite tight. They have to come down a bit, and this is something that the Fed has to look at when they take monetary policy into consideration.
Great. Thank you very much for joining us, Bob.
Thank you.